හොඳයි හැමෝටම අයබෝවන් කියලා ප්‍රාර්ථනා කරනවා. ඉතින් අද මම ඔයාලට අරන් ආවා අපේ financial management subject එකේ past paper discussion වල 2019 batch එකට තිබ්බ paper එක ගැන කතා කරන්න. ඉතින් මේ paper එක අපි කතා කරද්දි මම මේකටත් කලින් 2020 batch එකට වගේම මේ paper එකටත් මම model answers හදලා තියෙන්නේ. ඉතින් මේ model answers එක අපි බලමු මේ questions වලට කොහොමද අපි answers ලියන්නේ කියලා. ඉතින් මේ paper එකෙත් මම කලින් කිව්වා වගේම පොඩ්ඩක් structure ගැන කිව්වොත් එහෙම මේකෙත් පළවෙනි question එක ඇත්තටම දීලා තියෙන අපිට තනිකර theory වලින් දීලා තියෙන්නේ. ඊට පස්සේ අනිත් හැම question එකම වගේ යම් කිසි ප්‍රමාණයක් theories වලට allocate කරලා තියෙනවා. ඉතින් උදාහරණයක් විදිහට දැන් මේ පළවෙනි එක සම්පූර්ණ ලකුණු 20ක්. ඊට පස්සේ question number 2 එක බලන්න මේකෙන් ලකුණු 8කට. ඒ කියන්නේ question number 2 එකේ sub question 1 එකටයි sub question 2 එකටයි දෙකටම අපිට theory තමයි අහලා තියෙන්නේ. ඊට පස්සේ ඒ වගේම තමයි question number 3 එකෙත් අපිට question number 1 and question number 2 වලට theories අහලා තියෙනවා. මෙතනත් ලකුණු 8ක් වගේ ඇවිල්ලා තියෙනවා. ඉතින් ඒ වගේ හැම question එකකටම සාමාන්‍යයෙන් අපිට යම්කිසි ලකුණු ප්‍රමාණයක් අපිට cover කරගන්න පුළුවන් අපිට theories වලින්. එතකොට බලපුවාම සාමාන්‍යයෙන් paper එකේ ලකුණු සම්පූර්ණ 100න් අපිට ලකුණු 40ක් ලකුණු 50ක් වගේ ප්‍රමාණයක් අපිට theories වලින් විතරක් cover කරගන්න පුළුවන්. හොඳයි එහෙනම් අපි පළවෙනි question එකට එමු එකත් එක්ක. ඉතින් පළවෙනි question එකෙන් අපිට අපෙන් අහලා තියෙන්නේ what is finance and how does it different from the business finance. ඉතින් ඔයාලට මතක ඇති අපේ කලින් paper එකේ, ඒ කියන්නේ 2020 batch එකට දීපු paper එකේ මේ වගේම questions ටිකක් තමයි අහලා තිබෙන්නේ. ඉතින් අපි හරියට මේ ටික practice කරගත්තා නම් අපිට සාමාන්‍යයෙන් අර මම කිව්වා වගේ ලකුණු 40ක් විතර අපිට 40ක් 50ක් වගේ ප්‍රමාණයක් අනිවාර්යයෙන්ම cover කරගන්න පුළුවන්. මොකද එකම වගේ questions තමයි හැම පාරම මේ theories වලින් අහලා තියෙන්නේ. හරි. එතකොට ඔන්න අපි එහෙනම් බලනවා පළවෙනි එකට උත්තරේ. Finance refers to the study of money management, investment and the allocation of funds in various financial systems. It involves the analysis of financial activities such as acquiring, investing and managing resources to achieve financial objectives. On the other hand, business finance is a subset of finance that focuses especially on the financial activities within a business organization. It deals with the management of funds, financial decision making, and the planning and control of financial resources in a business context. The main difference between finance and business finance lies in their scope and focus. While finance encompasses a broader study of financial systems and activities, business finance narrows its focus to financial aspects within a business entity. Business finance involves applying financial principles and strategies to support business operations, manage cash flows, make investment decisions, evaluate financial risks, and maximize the value of the firm. In summary, finance is a broader field that covers the study of financial systems and activities in general, while business finance especially deals with the financial aspects and decision making within a business organization. එතකොට ඒ අනුව ගත්තාම අපිට සරලවම කියන්න පුළුවන් finance කියලා කියන්නේ අපි සාමාන්‍යයෙන් macro එහෙම නැත්නම් විශාල concept එකකින් විශාල focus එකකින් අපි finance ගැන කතා කරන එක. but business finance කියලා කියන්නේ එක organization එකකට මොකක් හරි business එකකට විතරක් අපේ scope එක narrow කරගෙන අපි finance ගැන කතා කරන එක. Then we are moving to the next question. Briefly explain the main fields of finance. එතකොට මේකෙන් අපි අහනවා finance වල තියෙන main fields. එතකොට business finance නෙමෙයි finance වල තියෙන main fields අහන්නේ. එතකොට මේකේ main fields වෙන්නේ සාමාන්‍යයෙන් corporate finance, investment finance, institutions and bankings, ඊට පස්සේ financial markets, international finance and personal finance. එතකොට ඔවා තමයි අපිට සාමාන්‍ය වශයෙන් තියෙන main fields of the finance. Right? So let's see the answer. Finance encompasses several main fields, each focusing on specific aspects of financial activities. Here are some key fields in finance. Corporate finance. This field deals with financial activities and decision making within a corporation. It involves managing capital structure, analyzing investment opportunities, evaluating financial risks, and making decisions to maximize shareholder value. Investments. The field of investments focuses on the analysis and management of various investment assets, such as stocks, bonds, real estate, and commodities. It involves assessing risk and return, portfolio management, asset valuation, and understanding market dynamics. Now, financial institutions and banking. This field revolves around the operations and management of financial institutions such as banks, credit unions, and insurance companies. It includes areas such as commercial banking, investment banking, risk management, and regulatory compliance. Then, financial markets. This field examines the functioning and behavior of financial markets, including stock markets, bond markets, foreign exchange markets, and derivatives market. It involves understanding market efficiency, trading mechanisms, pricing models, and the impact of market focuses on asset values. International finance. International finance focuses on financial activities that involve multiple countries and currencies. It deals with issues such as foreign exchange rates, international trade and investment, global capital flows, and managing financial risks in global context. Then personal finance. Personal finance relates to individual financial management and planning. It includes topics such as budgeting, saving and investing, retirement planning, insurance, tax management, and estate planning. These fields are interconnected and often overlap. Professionals in finance can specialize in one or more of these areas based on their interest and career goals. So those are the sectors that we or the fields of finance, right? Then let's move to the next question. What is financial management? Now we'll give some examples or the questions in the finance. Now we are giving the answers for what is meant by financial management. අපි දැන් මේ financial management කියන question එක තමයි අපිට හම්බුනේ. කලින් අපි finance කියන්නේ මොකක්ද කියලා තමයි කතා කරේ. Now, financial management refers to the process of planning, organizing, controlling, and monitoring an organization's financial resources to achieve its financial goals and objectives. It involves making strategic financial decisions, allocating funds effectively, and managing financial risks to maximize shareholder value and ensure the long-term sustainability of the organization. The main objectives of financial management include first one, profit maximization, then wealth maximization, liquidity management, optimal capital structure, and risk management. Now let's see. Profit maximization. Financial managers aim to maximize profits by making sound investment decisions, controlling costs, and optimizing revenue generation. Then wealth maximization. Financial managers strive to increase the wealth of shareholders by making decisions that maximize the value of organization's stock. Then liquidity management. Financial managers ensure that the organization maintains sufficient liquidity to meet its short-term financial obligations and operational needs. Then optimal capital structure. Financial managers determine the optimal mix of debt and equity financing to minimize the cost of capital and maximize the value of the organization. Then risk management. Financial managers identify, assesses, and mitigate financial risks that may impact the organization's profitability and financial stability. This includes managing market risks, credit risks, operational risks, and liquidity risks. Financial management involves a range of activities, including financial planning, budgeting, financial analysis, capital budgeting, working capital management, financial reporting, and financial decision making. It requires a solid understanding of financial principles, accounting principles, financial markets, and regulatory frameworks. Overall, financial management plays a crucial role in ensuring the effective and efficient use of financial resources to support the organization's strategic objectives and drive sustainable growth. Now let's go into the next question. How do investment decisions of a firm differ from its financing decisions? අපි මෙතන අපෙන් අහලා තියෙන්නේ මේ ඉන්වෙස්ට්මන්ට් ඩිසිෂන්ස් ඕගනයිසේෂන් එකේ තියෙන ඉන්වෙස්ට්මන්ට් ඩිසිෂන්ස් ඒ ඕගනයිසේෂන් එකේ තියෙන ෆයිනෑන්සින් ඩිසිෂන්ස් එක්ක වෙනස් වෙන්නේ කොහොමද? එතකොට මේක අපි කතා කරන්න ගන්නවා යම්කිසි බේස් කීපයක්. එකක් තමයි nature of decisions. ඊට පස්සේ objective එක අනුව අපි වෙනස දක්වනවා. time horizon එක අනුව risk consideration අනුව අපි මේ වෙනස කියලා දෙනවා. එතකොට බලන්න පළවෙනි අපිට ඉස්සෙල්ලාම as according to the model answer investment decision and financial decisions are two distinct aspects of financial management that involve different considerations and objectives within a firm. Here's how they differ. First one, nature of decisions. Investment decisions. Investment decisions involve determining where and how to allocate the firm's financial resources to acquire assets or undertake projects that are expected to generate future income or value. This includes decisions related to capital expenditures, acquisitions, research and development, and other long-term investments. Then financing decisions. Financing decisions, on the other hand, focus on identifying the optimal mix of debt and equity financing to fund the firm's investments. This includes decisions regarding issuing stocks, bonds, or other forms of debt, as well as determining the overall capital structure of the firm. Then the objective. First, investment decisions. The primary objective of investment decisions is to maximize the firm's long-term profitability and value. The focus is on selecting projects or investments that offer the highest potential return, considering factors such as risk, cash flows, and strategic fit with the firm's goals. Then financing decisions. The objective of financing decisions is to raise the necessary funds to support the firm's investment activities while minimizing the cost of capital. The aim is to strike a balance between debt and equity financing to optimize the firm's financial structure and maximize shareholder wealth. Then third one, according to the in time horizon, we can divide the investment decisions and financing decisions. So investment decisions. Investment decisions have a long-term perspective as they involve committing resources to projects or assets that may generate returns over an extended period, often several years or more. Financing decisions. Financing decisions have a relatively shorter time horizon as they address the firm's immediate and near-term funding requirements. These decisions consider factors such as current capital needs, debt repayment schedules, and maintaining appropriate liquidity levels. Then risk considerations. According to the risk considerations also, we can divide or distinguish the difference between the investment decisions and financing decisions. First, let's talk about the investment decisions. Investment decisions involve assessing and managing various types of risks associated with potential investments such as market risk, industry risk, operational risk, and financial risk. The focus is on evaluating the risk-return trade-off and ensuring that investments align with the firm's risk appetite and strategic goals. Then financing decisions. Financing decisions involve evaluating the financial risk and cost associated with the different financing options. Factors considered include interest rates, creditworthiness, market conditions, and the impact of the firm's capital structure. The aim is to raise funds at the lowest cost while maintaining an appropriate level of financing risk. In summary, investment decisions involve allocating financial resources to profitable projects or assets, aiming to maximize long-term value, while financing decisions focus on raising funds and determining the optimal mix of debt and equity financing to support the firm's investment while minimizing cost and risk. Then next question. The traditional objective of business firm is profit maximization. The theories based on the objective of profit maximization are derived from the neoclassical marginalist theory of the firm. Comment on this view of the modern approach. So making අපෙන් අහලා තියෙනවා මේ නියෝක්ලාසිකල් මාර්ජිනල් තියරි එකයි ඊට පස්සේ මොඩර්න් අප්‍රෝච් එකනුයි මේ බිස්නස් ෆර්ම් එක ට්‍රැඩිෂනල් ගෝල් එක ප්‍රොෆිට් මැක්සිමයිසේෂන්. එතකොට මේක ඇවිල්ලා ක්ලාසිකල් මාර්ජිනල් තියරි එකෙන් තමයි ආවේ කියලා කියනවා. ඉතින් අපිට කියනවා මේක ගැන මොඩර්න් අප්‍රෝච් එකකට මේක ගැන කතා කරන්න කියලා. Let's see how the model answer has been developed. The view that the traditional objective of a business firm is profit maximization is rooted in classical economic theory, especially the neoclassical marginalist theory of the firm. According to this perspective, firms are assumed to be profit maximizing entities that make rational decisions based on the pursuit of economic efficiency. However, in the modern approach to business and finance, the objective of profit maximization has been subject to criticism and has evolved to include broader considerations. Here are some key points to consider. They are stakeholder theory, long-term value creation, triple bottom line, ethical considerations, value maximization. Then stakeholder theory. Modern business approaches recognize that firms have responsibilities to multiple stakeholders, including shareholders, employees, customers, suppliers, communities, and the environment. Profit maximization alone may neglect these broader obligations. Then, long-term value creation. Rather than focusing solely on short-term profits, the modern approach emphasizes the creation of long-term sustainable value. This includes considering factors such as innovation, brand reputation, customer loyalty, and corporate social responsibility. Then, triple bottom line. The concept of triple bottom line incorporates financial, social, and environmental dimensions known as 3Ps, which are profit, people, and planet. This framework encourages businesses to consider their impact on society and the environment alongside financial performance. Then, ethical considerations. Ethical principles and corporate governance have gained prominence, highlighting the importance of integrity, transparency, and accountability in business decision making. Profit maximization may need to be balanced with ethical practices and compliance with legal and regulatory frameworks. Value maximization. Some argue that the objective should be focused on value maximization rather than purely profit maximization. This involves considering the overall value generated for stakeholders, including shareholders, employees, and society at large. It's important to note that the modern approach to business objectives is not uniform and varies across different contexts and perspectives. While profit remains a crucial aspect of business sustainability, there is an increasing recognition that the pursuit of profit should be balanced with other considerations to ensure long-term success and societal well-being. Next question. How did the global disaster change Sri Lankan finance sector and the economy? එතකොට මේකෙන් අහලා තියෙන්නේ මේ global disaster එක. නැත්නම් COVID-19 වගේ දෙයක් ඉන් මේ ලංකාවේ finance sector එක සහ economy එක කොහොමද වෙනස් වුනේ කියන එක. එතකොට මේකෙදි අපි කතා කරන්නේ බොහොම වැදගත් වශයෙන්ම COVID-19 impact එක ගැන. The COVID-19 pandemic outbreak had a profound impact on economies and financial sectors globally, including Sri Lanka. So මේකේ අපි impact එක කතා කරනවා economic impact එක, financial sector, government response, and social and humanitarian impact. Let's consider about the economic impact. The pandemic likely caused significant disruptions to various sectors of the Sri Lankan economy. Lockdown measures, travel restrictions, and reduced consumer spending could have led to a decreased economic activity, particularly in sectors such as tourism, hospitality, retail, and transportation. This could result in lower GDP growth and employment challenges. Then financial sector. The finance sector in Sri Lanka may have faced significant challenges during the pandemic. Financial markets globally experienced heightened volatility, and Sri Lanka was likely not immune to these effects. The stocks markets may have seen declines, and there could have been currency fluctuations and capital outflows. The banking sector may have grappled with increased defaults, liquidity pressures, and credit risk. Then we discuss about the government response. Governments typically implement measures to mitigate the economic impact of the pandemic. Sri Lanka's government may have implemented fiscal stimulus package and monetary policy adjustments to support affected industries, businesses, and individuals. Additionally, the government may have sought external assistance from international organizations or donors to manage the crisis and aid in recovery process. Of course, the typical situation in the Sri Lanka at the present also. Social and humanitarian impact. The COVID-19 pandemic has had profound social and humanitarian consequences. The health and well-being of Sri Lankan population may have been significantly impacted, with efforts directed towards controlling the spread of virus and providing healthcare services. The government may have allocated resources to support relief and recovery efforts, potentially leading to increased government debt and fiscal challenges. Now let's move into the next question. ඊළඟ ප්‍රධාන question එක අපිට පළවෙනි ප්‍රශ්න දෙකම අහලා තියෙන තියරි. එතකොට පළවෙනි ඒ question එකේ එක ප්‍රශ්නයකට ලකුණු 4කුත් අනිත් ප්‍රශ්නවල ලකුණු 4 බැගින් සම්පූර්ණ ලකුණු 8ක් මේ question එකේ question number 2 එකේ theory වලට allocate වෙලා තියෙනවා. Now let's see the answers for these questions. Okay, under the question number 2, first question. Briefly explain what is meant by compounding and discounting of cash flows. Compounding and discounting of cash flows කියන්නේ මොකක්ද කියලා අපිට කියන්න කියනවා. Compounding and discounting are fundamental concepts used in finance to evaluate the value of cash flows over time. Here's a brief explanation of each. First one, compounding of cash flows. Compounding refers to the process of calculating the future value of an investment or cash flow by adding the accumulated interest or earnings to the initial investment or principal amount. In other words, it involves reinvesting the returns generated by an investment to generate additional returns in subsequent periods. The compounding process takes into account the time value of money, which states that money today is worth more than the same amount of money in the future due to the potential to earn interest or returns. Through compounding, the investment grows over time as the earnings or interest earned are reinvested and themselves start generating additional returns. For example, if you invest 1,000 rupees in a saving account that pays an annual interest rate of 5% compounded annually, at the end of the first year, you will earn 50 interest, result in total of 1,050. In the second year, the interest is calculated based on the new total amount of 1,050, leading to a higher returns. This compounding process continues, generating greater returns over time. Second one, discounting of cash flows. Discounting is the reverse process of compounding. It involves calculating the present value of the future cash flows by reducing their value to reflect the time value of money and the risk associated with receiving the cash flows in the future. The discounting process uses a discount rate typically based on the cost of capital or the desired rate of return to determine the present value of future cash flows. By discounting, the future cash flows are adjusted downward to reflect their current value in today's terms. Discounting is commonly used in techniques such as net present value (NPV) analysis and the discounted cash flow or DCF analysis. These methods assess the profitability and value of investment by discounting the expected future cash flows back to their present value. For example, if you are promised to receive 1,001 from year, sorry, 1,000 1 year from now, and the discount rate is 10%, the present value of the future 1,000 cash flow would be 909.09. This means that 909.09 today is considered equivalent in value to 1,000 received 1 year later, taking into account the time value of money and the discount rate. In summary, compounding and discounting are fundamental concepts in finance. Compounding calculates the future value of cash flows, reinvesting earnings, while discounting determines the present value of future cash flows by adjusting them to reflect their current value. These concepts are used to evaluate investment returns, compare different investment options, and make financial decisions based on the time value of money. Let's move into the next question, and the question number 2. Second question, briefly explain the importance of time value of money in decision making. The time value of money, TVM, is a fundamental concept in finance that recognizes the inherent value of money over time. It states that the value of money today is greater than the same amount of money in the future due to its potential to earn interest or returns and the uncertainty associated with future cash flows. The importance of time of time value of money in decision making can be understood through the following points. Those points are investment evaluation, capital budgeting, risk and uncertainty, and financial decisions, inflation and purchasing power, and financial planning. Let's consider about the investment evaluation. Time value of money is crucial when evaluating investment opportunities. By considering the time value of money, decision makers can assess the potential returns and risk associated with different investment options. They can compare the present value of investment cost with the future expected cash flows to determine the profitability and financial viability of an investment. Capital budgeting. Time value of money plays a significant role in capital budgeting decisions where companies allocate their financial resources to long-term investment projects. By discounting future cash flows at an appropriate rate, such as companies' cost of capital, decision makers can assess the net present value (NPV) of the project. Projects with positive NPV are typically considered favorable as they generate returns that exceed the cost of capital. Risk and uncertainty. TVM, or time value of money, recognizes that future cash flows are uncertain. By incorporating a discount rate that reflects the level of risk, decision makers can account for the uncertainty associated with future cash flows. Projects with higher risk or longer time horizons are generally subject to higher discount rates, resulting in lower present values and potentially impacting the decision to undertake the project. Financial decisions. Time value of money is also relevant in financing decisions when considering different sources of finance. Decision makers are Decision makers evaluate the cost of capital and the time value of money associated with each option. They assess the interest rates, repayment terms, and the impact of different financing structures on companies' cash flows and profitability. Inflation and purchasing power. Time value of money helps account for inflation and its impact on the purchasing power of money. Inflation erodes the value of money over time, and decision makers need to consider the inflation rate when evaluating future cash flows. By discounting future cash flows at a rate that includes the expected inflation, decision makers can reflect the change in purchasing power of money. Financial planning. Time value of money is an essential component of financial planning and goal setting. By understanding the time value of money, individuals and businesses can make informed decisions about saving, investing, and achieving their financial objectives. They can calculate the amount of money needed to meet future obligations, such as retirement savings, education funds, or business expansion plans. In summary, the time value of money is crucial in decision making as it allows for a more accurate assessment of the value and profitability of investments, considering the potential returns, risks, inflation, and uncertainty associated with the future cash flows. By incorporating time value of money in decision making, individuals and business can make more informed choices and optimize their financial outcomes. With that, we are ending the question number 2, and now let's move to question number 3. In question number 3, there also we have been given 2 questions asking from the theory parts, and it covers total of 8 marks, like 6 marks for first question and 2 marks for second question. Right? Altogether, 8 marks are given. Okay. Question number 3, part 1. Briefly explain what is meant by credit rating and its importance to issuers and investors. A credit rating refers to an evaluation of creditworthiness of a borrower or issuer of debt securities such as governments, corporations, or financial institutions. It is an assessment conducted by credit rating agencies to determine the likelihood of the borrower's ability to fulfill its debt obligations. Credit ratings are typically assigned by specialized agencies such as Standard and Poor's, Moody's, or Fitch Ratings. These agencies assess various factors including the borrower's financial stability, repayment history, cash flow, industry conditions, management quality, and economic environment to assign a rating that reflects the level of credit risk associated with the borrower. The credit rating is usually represented by a letter grade or symbol such as AAA, AA, single A, triple B, etc., with each grade indicating a different level of creditworthiness and associated risk. Higher ratings indicate lower credit risk, while lower ratings suggest higher credit risk. The importance of credit ratings can be understood from the perspectives of both issuers, borrowers, and investors. Importance to issuers. Access to capital. A favorable credit rating is crucial for issuers as it affects their ability to access capital at favorable terms. A higher credit rating enhances an issuer's reputation and credibility in the financial markets, making it easier to attract investors and lenders. It increases the issuer's chances of obtaining financial at lower interest rates and favorable terms. Cost of borrowing. The credit rating directly affects the cost of borrowing for issuers. A higher rate credit ratings translates to lower perceived credit risk, allowing issuers to borrow at lower interest rates. This reduces their borrowing cost and consequently improves their financial position by reducing interest expenses and increasing profitability. Market perception. Credit ratings provide a measure of confidence and trust to potential investors and lenders. A higher credit rating indicates a lower risk of default, attracting a broader investor base and enhancing market perception. It can improve the issuer's ability to issue debt securities, raise capital, and establish credibility in the market. Importance to investors, risk assessment. Credit ratings are crucial for investors as they provide an assessment of the credit risk associated with a particular issuer of debt instrument. Investors rely on credit ratings to evaluate the likelihood of timely interest and principal repayments. Higher rated bonds are considered less risky, while lower rated bonds carry higher risk. Credit ratings help investors make informed investment decisions based on their risk tolerance and desired returns. Investment decision making. Credit ratings serve as a tool for investors to compare and evaluate different investment options. Ratings allow investors to assess the relative creditworthiness of issuers and make decisions based on risk return trade offs. Investors often incorporate credit ratings into their investment strategies to manage risk and allocate their portfolios accordingly. Regulatory requirements. Institutional investors, such as pension funds, insurance companies, and mutual funds, often have regulatory requirements or investment policies that mandate minimum credit ratings for their investments. Meeting these requirements ensure compliance and help manage risk within their investment portfolios. In summary, credit ratings are essential for both issuers and investors. They provide an objective assessment of creditworthiness, influencing an issuer's ability to access capital and the cost of borrowing. For investors, credit ratings help assess the risk associated with investments and make informed decisions based on their risk appetite and investment objectives. Second part, compare the features of a common stock against features of debenture. First, common stocks, ownership, returns, risk, priority in claims, and voting rights. So common stocks, the ownership, common stocks represents ownership in a company. By holding common stock, an investor becomes a partial owner and it is entitled to voting rights in the company's decision-making processes. The returns, common stockholders can benefit from potential capital appreciation and dividends. They have the opportunity to earn returns if the company's stock price increases and can receive dividends if the company distributes profits to shareholders. Risk, common stock carries higher risk compared to debt instruments like debentures. Stockholders are exposed to fluctuations in the stock market and company performance. If the company faces financial difficulties, common stockholders may bear the loss and may not receive their initial investment back. Priority in claims. Common stockholders have the lowest priority in claiming company assets in case of bankruptcy or liquidation. They are paid after bondholders, debenture holders, and other creditors have been satisfied. Voting rights. Common stockholders generally have the right to vote in corporate matters such as electing the board of directors, approving major decisions, and participating in shareholder meetings. The number of votes is usually proportional to the number of shares owned. Debenture. As a debt instrument, fixed interest payments, maturity date, security, priority in claims, no voting rights. Debenture, the debt instrument. A debenture is a type of debt instrument issued by a company to raise capital. It represents a loan provided by debenture holder to issuing company. Debenture holders are creditors of the company and do not have ownership rights. Fixed interest payment. Debentures typically carry a fixed rate of interest which is paid to debenture holders at regular intervals such as quarterly or annually. The interest payment is a contractual obligation of the issuing company and is usually predetermined. Maturity date. Debentures have a specific maturity date, which is the date when the principal amount of the debenture is repaid to the debenture holder. It represents the end of the long term and the company is obliged to repay the principal amount to the debenture holders. Security, debentures can either secured or unsecured. Secured debentures are backed by specific assets of the company, providing collateral to the debenture holders. In case of default, debenture holders have a claim on the specific assets. Unsecured debentures are not backed by specific assets and are considered riskier. Priority in claims. In case of bankruptcy or liquidation, debenture holders have a higher priority in claiming company assets compared to common stock holders. They have a greater chance of recovering their investment since they are considered creditors of the company. No voting rights. Unlike common stockholders, debenture holders do not typically have voting rights in the company's decision-making processes. They are not entitled to participate in shareholder meetings or vote on corporate matters. In summary, common stock represents ownership in a company with potential capital appreciation and voting rights. While debentures are debt instruments that provide fixed interest payments and have priority in claims over common stockholders, common stock carries higher risk but offers potential for higher returns. While debentures provide a fixed income stream with lower risk. Now let's move to the next question, question number 4. In there, the first question carries 2 marks, which is a theory question. Right. Only the first question carries 2 marks as a theory question. Right. Now let's see what is heard from there. What is a systematic risk? How can systematic risk of a security be calculated? Systematic risk කියන්නේ මොකක්ද සහ systematic risk එක calculate කරන විදිහ තමයි අපි මේකෙන් අහලා තියෙන්නේ. It carries only 2 marks, but there's a large example answer for you to get a better idea, right? Systematic risk, also known as market risk or non-diversifiable risk, refers to the risk inherent in the overall market or economy that affects the entire market or particular segment rather than being specific to an individual security. It is the risk that cannot be eliminated through diversification because it is related to external factors affecting the entire market. Systematic risk arises from factors such as macroeconomic conditions, geopolitical events, interest rate fluctuations, inflation, changes in investor sentiment, and overall market conditions. These factors impact the prices of securities across the market, leading to a systematic risk. To measure or calculate systematic risk, a commonly used metric is beta. Beta measures the sensitivity of the security returns to change in the overall market. It indicates how much the price of a security is expected to move relative to the movement of the market as a whole. A beta of 1 indicates that the security tends to move in line with the market, while a beta greater than 1 suggests the security is more volatile than the market, and a beta less than 1 indicates lower volatility compared to the market. The formula to calculate beta is beta equals covariance divided by variance. So the covariance of security returns or market returns divided by the variance of market returns, where covariance represents the statistical measure of how the returns of the security and the market move together, and the variance represents the measure of dispersion of the market returns. By calculating the beta of a security, investors can assess its systematic risk. A beta greater than 1 implies that the security is expected to be more volatile than the market, while a beta less than 1 suggests lower volatility compared to the market. It's important to note that beta is just one measure of systematic risk, and other risk factors and considerations should also be taken into account when evaluating the overall risk of security portfolio. Let's move into the question number 5. In there, the first question is a theory question which carries 5 marks. Yes. Okay. Only first question is asked of a theory. Right. Question number 5, part 1. Briefly explain the importance of estimating cost of capital of the firm. Estimating the cost of capital of a firm is crucial for several reasons. First, investment decision making. Second, capital budgeting. Third, performance evaluation. Fourth, valuation of the company. And fifth, financing decisions. Right. Investment decision making. The cost of capital is a key factor in evaluating investment opportunities. It helps determine the minimum rate of return that project or investment should generate to consider financially viable. By comparing the expected returns of an investment with the cost of capital, decision makers can assess whether the investment is likely to create value for the firm. Estimating the cost of capital ensures that the company allocates its resources efficiently and makes informed investment decisions. Capital budgeting. The cost of capital is used in capital budgeting decisions where companies evaluate and prioritize investment projects. By discounting future cash flows at the cost of capital, decision makers can determine the net present value (NPV) of a project. Positive net present value projects are typically considered favorable as they are expected to generate returns that exceed the cost of capital. Estimating the cost of capital accurately helps identify projects that will enhance shareholder value and contribute to the firm's overall financial performance. Performance evaluation. The cost of capital is used as a benchmark to assess the performance of business units or divisions with the company. By comparing the return on investment (ROI) of different units with their respective cost of capital, managers can evaluate how effectively the units are generating returns for the firm. Units that consistently achieve returns above their cost of capital are considered to be creating value, while those with returns below the cost of capital may require further analysis and improvement. Valuation of the company. The cost of capital is critical input in determining the value of the company. By discounting the expected future cash flows of the firm at the cost of capital, analysts and investors and estimate the present value of the firm. Valuation methods like discounted cash flow (DCF) analysis rely on the cost of capital to determine the worth of the company. Accurate estimation of the cost of capital ensures a more reliable valuation of the company and assists in making the investment decisions from an investor's perspective. Financing decisions. The cost of capital influences financing decisions, such as choosing between debt and equity financing or evaluating different sources of capital. It helps in determining the optimal capital structure that minimizes the overall cost of capital for the company. By understanding the cost of capital, firms can make informed decisions regarding the mix of debt and equity financing to optimize their capital structure and balance the trade-off between risk and costs. Question number 6. Right. In question number 6 also, the first question is asked in theory, which carries 4 marks. Right. Question number 6, part 1. Differentiate between profits and cash flows. Why are cash flows important in investment decisions? Profits and cash flows are two distinct financial metrics that provide different insights into companies' financial performance. Here's how they differ. Profits. Profits, also known as net income or earnings, represent the residual amount after deducting all expenses, including taxes, interest, and operating costs from total revenue. Profits are calculated based on actual accounting principles which recognize revenues and expenses when they are incurred, regardless of when cash is actually received or paid. Profits are reported on the income statement and are used to measure a company's profitability over a specific period. So, when referring to the cash flows, on the other hand, represent the actual inflows and outflows of cash into and out of a company during a given period. It includes cash received from customers, cash paid to suppliers, employees, and lenders, as well as cash used for investments and other operating activities. Cash flows are reported in the statement of cash flows and provide a more accurate picture of the company's liquidity and ability to generate and manage cash. Now let's discuss why cash flows are important in investment decision making. Cash is tangible. Cash flows provide a more tangible measure of companies' financial health than profits because cash is the lifeblood of any business. Positive flows, positive cash flows ensure that a company has sufficient liquidity to meet its short-term obligations such as paying bills, salaries, and servicing debt. It indicates the company's ability to generate cash internally to support its operations and investment activities. Cash flow timing. Cash flows consider the timing of cash inflows and outflows, which is essential for investment decision. Investments require upfront cash outlays, and investors need to assess the timing and magnitude of future cash inflows to evaluate the attractiveness and feasibility of an investment project. Cash flow projections help determine the payback period, net present value or NPV, internal rate of return IRR, and other investment metrics that guide decision making. Risk assessment. Cash flows plays a crucial role in assessing the risk association with an investment. The uncertainty of future cash flows affects the overall riskiness of an investment project. By analyzing cash flows projections and considering factors such as market conditions, competition, and economic trends. Investors can better evaluate the risk and potential returns of an investment opportunity. Capital allocation. Cash flows aid in determining the allocation of capital among different investment options. Investors can compare the cash flows and profitability of different projections to identify the most promising investment opportunities. Cash flow analysis helps prioritize investments that generate positive cash flows, create value, and contribute to the overall financial objectives of the company. Financial stability. Sustainable positive cash flows are crucial for long term viability of a business. Cash flows provide a measure of financial sustainability and help investors assess whether a company can generate consistent cash inflows to support its growth, debt repayment, dividend payments, and reinvestment in the business. Positive cash flows are essential for the company's ability to weather financial challenges and uncertainties. In summary, cash flows are important in investment decisions because they provide a more tangible measure of companies' financial health. Consider the timing of cash flows, help assess risk, guide capital allocation, and indicate the financial sustainability of a business. While profits are an important indicator of profitability, cash flows provide critical insights into the availability of management of cash, which is vital for investment decision making. Question number 7. Okay, in the question number 7, here we are being asked to write some short notes for the following, and it carries 6 marks. Question number 7, part 1, part A. What is theorem? The theorem, also known as the Modigliani's and Miller theorem, states that under certain assumptions, the value of a firm is independent of its capital structure. It implies that the way a firm is financed through debt or equity does not affect its overall value in a perfect and efficient capital market. Part B. In the view of theory, what is the relation between value of a firm and its capital structure in absence of corporate income taxes? According to theory, in the absence of corporate income taxes, the value of a firm is unaffected by its capital structure. This means the total value of firm remains the same regardless of the proportion of debt and equity used to finance its operations. Investors can achieve the same return by adjusting their personal leverage. This capital structure becomes irrelevant in determining the firm's value. Part C, explain why, according to pecking order theory, firm prefer internal financing to external financing. The pecking order theory suggests that firms prefer internal financing, retained earnings, over external financing, debt or equity issuance. Due to information asymmetry and adverse selection problems, firms tend to use internal funds first because managers have better information about the company's prospects and risk compared to external investors. External financing may send negative signals to the market and result in a higher cost of capital. Therefore, the pecking order theory states that firms will resort to external financing only when internal funds are insufficient. Part 5 briefly explain the following. Here we also have another one which also carries 6 marks, and there are 3 points to be explained, right? That means for 1 point we have given 2 marks, right? Okay. Dividend relevance theory. The dividend relevance theory proposed by Modigliani and Miller suggests that in a perfect capital market, the value of a firm is not affected by its dividend policy. According to this theory, investors are assumed to have no preference between dividends and capital gains. The value of a firm is determined solely by its underlying investment opportunities and the required rate of return. Therefore, whether a firm pays dividends or returns earnings to reinvest in the business should not impact the firm's overall value. Part B, client effect. The client effect refers to the phenomena where the announcement of dividend change by company influences the demand for its shares by different groups of investors. When a company announces an increase in dividends, it may attract income seeking investors who prefer higher dividend payouts. This can lead to an increase in demand for company shares and potentially drive up the stock price. Similarly, decrease in dividends may discourage income-seeking investors and result in decrease in demand and stock price. The client effect highlights how dividend policy can affect the investor base and market perception of a company. Final one, residual dividend model. The residual dividend model is an approach used by companies to determine the amount of dividends to be paid to shareholders after meeting all the company's capital expenditure and financial obligations. According to this model, dividends are paid out of the residual or leftover earnings after funding investment opportunities and maintaining the desired capital structure. The residual dividend policy suggests that dividend payments are not predetermined or fixed, but are based on the availability of funds. Companies prioritize reinvestment in profitable projects and meeting financial obligations before distributing dividends. The residual dividend model aims to strike a balance between rewarding shareholders with dividends and ensuring the company has sufficient funds for growth and financial stability. So with that, we have come to end of discussing the past paper of the batch 2019. So ඉතින් ඒකත් එක්ක අපේ මේ 2019 බැච් එකට දීපු පේපර් එක ඩිස්කස් කරන එක අවසන් වෙනවා. සෝ මම ඉක්මනට ඊළඟ පේපර් එකත් කතා කරලා වීඩියෝ එක අප්ලෝඩ් කරන්නම්. එහෙනම් එතකන් ඔයගලන්ට සුබ දවසක්. Thank you.